Vaibhav Sanghavi of Avendus Capital Alternative Strategy Private Limited is now joining us. Vaibhav, as far as markets are concerned, what is your view, especially after the policy when the stance was changed, rates was not cut versus estimates, still markets are going up?
I think market carries phenomenal momentum in terms of the liquidity, especially on the domestic side. And they're refusing to go down because of the wider interest into the markets. Having said that, taking momentum aside and focusing on fundamentals, what we think is in a scenario where global growth is stabilizing and is looking up, at the same time in India we are now looking forward after demonetization and remonetization. We think that growth should come back to the economy probably after March 31st or probably after this quarter. And there is good amount of consumer pent-up demand lying into the economy which may come back. So we think that on an economic basis, we are looking up in terms of growth, wherein both the global and the local factors are of support. The only caveat here I would like to say is basically the policies emanating from US, and something to watch out for is basically if there is any trade protection or change in trade balances. So that is something to watch out for. Otherwise, it looks pretty okay in terms of the momentum, at least in the short term. Fundamentally, the valuations are on the little higher side, but till the more time the momentum are there, you might not see a substantial correction going forward.
Do you think that liquidities can work both ways, and once this high liquidity from the domestic side goes away, the downside risk in the market will be very high because now it's being only supported by liquidity?
Absolutely. I mean, it always goes without saying that liquidity is a two-way sword, in the sense that when you see drying up of liquidity either on any of those quarters in a massive way, you see these kind of corrections coming, which are pretty sharp and quick, wherein it doesn't give much time to react. Having said that, looking at the profile of what the liquidity is, I think there are a huge amount of investments coming on the SIP side of, which is SIP side on the mutual funds, which brings huge amount of stability to the monthly flows. So I don't foresee any big jolt to the domestic liquidity side. It's only that on a global side, wherein for the last couple of months, where we were seeing developed markets versus an emerging market trade being entered into, if some amount of reversal happens on that count, you will see further momentum pushing on to the Indian markets.
Right. As far as decline in rates is concerned, that was the key story in India from 2014. Do you think with the stance changing yesterday, that is something which will not support the markets anymore? Rates coming down, equity valuation going up?
Fundamentally, yes, because always a rising rate scenario is not it has not been very good for the economy. At the same time, the change in the stance of the rate is actually very important and has to be taken notice of. And we definitely think that given the light where there's a global growth, plus your commodity prices getting stronger, plus your core inflation here is not moving much or not going down much, we think that inflation has to be is back in focus. And if this number is stubbornly not decreasing, then we are in for some amount of hawkish period of time. So of course that would definitely affect sectors which are rate sensitive, right from banks to anything in terms of consumer discretionary as well.
After demonetization, markets were expecting huge rate cuts to come in. Now that is not coming, is that a disappointment?
I would not term that as a disappointment, because our rate cuts or our rate policies is a combination of both local and domestic local and global factors. In local side, yes, you saw a huge amount of liquidity coming back, and that is why we saw the MCLRs actually getting down. But in terms of getting the benchmark rates, one generally, or probably we feel that the institution, the RBI, generally see what's happening to the global commodity cycle. And if you also notice that, US 10-year actually is at about 2.5%, which is quite stable, and has rallied from those of about 1.6, 1.7. Now, if we keep on decreasing rates, then the spreads between the US 10-year and probably an Indian 10 keeps on decreasing, which probably may not be attractive in terms of capital flows. Beyond the point, it was going to be difficult for RBI to cut rates in the light that the commodity prices are getting strong. So yes, again, we have to differentiate between at the cost of repetition, the benchmark rates and probably the MCLRs. The MCLRs are decreasing, and as rightly mentioned by the Honorable Governor yesterday, that there is some amount of scope on decrease of MCLR further because the transmission has not happened completely.
In terms of market valuation, in terms of earnings, FY18 earnings, last year you told FY17 earnings are optimistic, and we've seen downgrades coming in. FY18 earnings, now that we are coming close to March, what will be your view?
See, again, this is a story. Every year it does begin with a very optimistic picture, right? The street estimates that the FY18 earnings would be close to about 20%. But we feel that between 10 to 15% is better, a rational number. Having said that, it's extremely difficult to pinpoint or probably forecast the numbers at this point in time, because we don't know that the effect of remonetization and demonetization, how much time will it take, and if it takes further period of time, what is the effect on growth. There are a lot of moving parts, but it is safe to assume that we would be on the lower side of the street, which is currently close to about 20%. So we are at about between 10 to 15% of in terms of the EPS growth.
Right. In terms of market expectation, say if the earnings growth comes in close to what street is estimating for FY18, or say 1-2% miss here and there, you think markets will not be very disappointed?
Oh, of course not. I mean, if the earnings are if they are anyway close to even 70 to 18% also, I don't think markets would be disappointed at all. I think then we have a good case of further rally into the markets going forward. It's just that let the numbers come, and then probably we will take a call again on revision on the higher side, if any we have to do. But you are absolutely right that if it is close to 20%, probably a couple of points away, market would not be disappointed at all. I think it will be taken very positively.
As far as earnings are concerned, what do you think are factors that will drive the earnings? So till now we've seen downgrade factors. Last year it was metal prices going down, AQR processed by RBI, all that led to earnings down. Now it is demonetization. What do you think are factors which will lead to earnings growth in FY18?
I think the biggest factor of the earnings growth is the behavior of consumer. Now, we have an excellent demographic profile, right? But if you see in this quarter as well as in the last quarter, the amount of demand has been curtailed purely by the factors like demonetization. What we need to clearly see is how, there is definitely a huge amount of pent-up demand into the economy. When it comes through, at what point in time is something we'll have to watch it closely and watch the consumer discretionary numbers which come on a monthly basis to have a better track of. At the same time, the capex is there. We have planned expenditure probably going into rural, agri, as well as some amount of capex into railways and transportation. I think from the government angle, they are in support of spending money, which definitely will provide some amount of support to the industrial segment. Having said that, the private capex is something which we have to again closely watch. We don't think that it returns pretty soon. and it will still take some amount of time for that to get back into places. But otherwise, it's pretty much a normal story every year. Banking and financials, retail lending, consumer sentiment, and consumer pent-up demand coming back is something which we would probably watch closely, and these would be the drivers of earnings going forward.
Till now, a lot of investors were favoring in NBFCs versus banks. Do you think that can change now with yields getting slightly harder than what they are, banks not in a pressure to cut rate for loan growth? Do you think that that can change and corporate banks can do well?
And we have, for a long time, we've been with the thesis that, banks with retail focus are something which are more preferable for us. I don't think that we are changing that view. I mean, we are still focusing on banks with a higher retail focus. Corporate banking is something which we still do not have any reasons to believe that the pain is out and we are on a super recovery mode from either the corporate SME side. We still further will focus on retail lending, wherein you command a premium in terms of the spreads, and those guys who have a wide network of incremental retail loan growth is something which we would focus on. In terms of the NBFCs, yes, the increase in cost of funding may affect a bit in a shorter term at least, but they are in a unique space. So in NBFCs also we would differentiate between microfinance and probably NBFCs with retail lending again in terms of consumer durables. So that is a segment again we will focus on going forward in NBFCs as well.
For NBFCs, rates coming down was one leg of the up move that investors had seen last 2 years. Do you think that is now behind, but growth rate still continues to be very high? So you mentioned about microfinance companies. There, the growth rates are still quite phenomenal.
The growth rates are very good. The only caveat here again is basically let the whole election period get over, because you generally notice that during the election period you will see some amount of microfinance companies would not have a fantastic collection cycle. So let this period get over, and any which ways these stocks are trading pretty expensive. Definitely, it comes with growth, but we will wait for microfinance to invest in microfinance at a better entry point than at present. In terms of the NBFCs, yes, the lending rates, which are now the stance changing in terms of rates, would have some amount of effect on the future borrowing cost for themselves as well. So that is something also we'll have to look forward to.
Right. As far as banking sector is concerned, especially the PSU banks, do you think valuations are attractive if one were to assume that asset quality is now getting stable, even though growth is not there in terms of loan book or major profitability growth?
Yeah, so in terms of, let's have a look at two pieces of this, price to book and price to adjusted book. Now, if you see price to book, which is close to about 0.7 times, on an average basis, whereas if you go and see price to adjusted book, everybody is running over and above 1 time book. At the same time, going forward, we think that yes, the incremental stress may not be there, or the headline number of NPA might not increase going forward, but it is not going to happen that there is going to be super recovery on the ROA front or ROE front for the next 1 year. So we think that they are pricing in adequately in terms of the risks. Secondly, if there are any events or news or relating to the sector, like when many participants were talking about bad bank, if those kind of news and news flow is continuing into the sectors, you will see some amount of momentum still further there into PSU banks. However, on a fundamental basis, I think no recovery on an ROA and ROE basis on a further 1 year basis doesn't warrant me to give excessively high multiple, and in which price to adjusted is already running over the book.
When you compare this with private banks, all the matrices, don't you think the valuations are factoring in the best as well?
No, of course, right. I mean, the pain is a reflection of what you have in terms of the valuation, for sure. But let's keeping aside valuations, let's look forward in 1 year or 2 year perspective. That who is in ability to grow their loan book pretty much fast is those guys who are well capitalized, have wide network, and have the management bandwidth to take on those kind of growth numbers. We think that private banks are pretty much there in terms of capturing the incremental growth opportunity of lending. And that's where our focus is. Definitely it comes at a premium, but we are happy to pay that premium for getting the growth in terms of all areas.
Right. In terms of banks and NBFC, do you think now the focus will shift on investment side rather than only these financing names which have been doing very well?
No, of course. I mean, investments for sure. Yes, it's a sector which is now gone past in terms of the trading bands, but it's a tricky proposition because investments are again, coming up onto their own books. How do you treat them? What are the risk measures? So there are various factors again to look forward to. But banking and finances work basically on the financing model any which ways, right? So that is the core area which I don't think one should ignore.
Right. You said that you don't know when that pent-up consumer demand is going to come forth. So how do you play the consumer names? Will you buy at dips? Would you buy now? What are the names that you like?
No, of course, I would buy now because I don't know whether it takes a quarter or 2 quarters. But one thing is pretty sure that given the demographic profile and the pent-up demand, and we have seen in past also, where if there is any aberration of demand disruption, it is pretty temporary and the demand pretty much comes back later on. We think that because of our demographic profile, this consumer demand, both on the staples and on the discretionary, would come back to the economy pretty, sooner or later. So that is a space we would like to bet on. In terms of our picks, I think consumer staples, we are pretty selective because the larger basket is trading at pretty high multiples. Whereas in case of the consumer discretionary, we would focus on four-wheelers. We would also be bullish on building materials to an extent, given the focus of government on affordable housing. So those are the segments where we are bullish on the consumer side.
How would you pick among consumer staples? You don't have comfort in the valuations there. Then what would you watch out for? Because many of them do have a predictable line of earnings, stable volume growth, not very, very good. How would you pick from the consumer staple space?
No, in case of consumer, as I said, the overall average multiples is higher. Not that I'm saying that they, across the board, we don't have any buying opportunities. We are definitely looking for strong brand plays, rural focus themes, and premiumization, which are our core focus in terms of evaluating any names, apart from the valuation. So we would have these 3 screeners pretty much in place before we go and invest into a particular name of the consumer staples. Having said that, the whole sector actually looks, pretty good in terms of that, after demonetization, we have seen correction in this whole space. And once the consumer demand comes back, which is just a matter of time, you will see some amount of sizable appreciation in whole, the complete consumer space.
Right, but would it be a safer bet to play the proxies here, maybe NBFCs, in home improvements or the building demand space? Would that be perhaps a better bet?
No, of course, building demand is something which we are bullish on, no doubt about it, make no mistake. But in case of the NBFCs, again, other NBFCs have various segments into an NBFC, right from microfinance, housing loans, and into companies which are into CV financing, or in the companies which are into consumer durable financing or white good financing. What we think is those NBFCs with larger focus on white good financing, plus housing loan NBFCs are something which we would like to have our bets on. In case of the microfinance, traditional microfinance, What we are only just waiting is basically the whole round of election getting over and one more quarter of results getting through. It is then probably we will again reevaluate, at what levels to enter into that space. I'm no way saying that the business are bad. The business are extremely good, robust. It's just we are trying to time the entry and at a better entry point.
All right. Previously, you also spoke about the risk coming in from U.S. trade policy. If nothing untoward plays out there, then would you favor the export-oriented companies as well? Do you think their prospects could improve from here on? Or are there other risks to, say, IT and pharmaceutical stocks, and their returns may not be as good as some of the domestic plays?
Sure. See, the IT and the performance of IT and pharma companies actually show, what are the worries which are there on the global side. In absence, or let's assume the best scenario where you don't have any trade restrictions or trade policies, I think as you rightly mentioned, the export-oriented stocks will surely do well. Having said that, 3 or 4 or a couple of more events which you need to closely look for. One is basically the French election, which is probably this year, and that will to a great extent shape up the whole eurozone. At the same time, the trade wars, potential trade wars, lifting of or having those barriers in terms of excise, foreign tax or something like that, is something one has to closely watch on. And whether that does spiral up, with global economies. So that is my only worry. But otherwise, if you see on a global growth perspective, I think good signs are that the commodity cycle has bottomed out. To the global growth projections, which we were talking about earlier at about 3.1 to 3.5%, I think is is likely to hit on the higher side. So those are good positive indicators, apart from the positive jobs data, which has always been consistent in the US. Definitely there are good amount of positive signs in the global economies. But as I mentioned, have a look at these 2 or 3 important variables which are out there, which can pose potential negative going forward. Otherwise, it should be pretty stable and positive for your export companies.
Right. Now, you spoke about the global commodity cycle having bottomed down. What does this mean for Indian companies? Do you think from here on, perhaps top line growth will be more significant, and maybe the bottom line growth may not be as much of input cost increase? Or do you think that good companies will be able to see reasonable growth both on bottom line and top line? If the growth visibility comes back, bottom line will be managed better. Whenever this commodity cycle bottoms out, you will always see that those integrated companies who have back-to-back integration would perform the best when the prices are on the upswing. Because whenever there are prices are on the up move, you will also see the prices of iron ores or your coals and your other intermediaries also going up in terms of the raw materials. So integrated players would be the biggest beneficiary. Having said that, on a sentiment basis also it is extremely important once people see the price rise happening across commodities, which helps them frankly to eke out whatever profits they can, apart from their regular efficiencies which generally they play out with. So on a sectoral basis, once there is bottom made on the prices, it's surely a good time, and the proportionate movement in the stock prices can be much more, which is extremely difficult to keep a tab on.
Right, but with commodity prices bottoming out, do you expect commodity prices to go up, because that could work negative for a lot of companies in terms of raw material? Yeah,
and that's why I said right at the beginning that the oil price, if on the upswing, at the same time commodity prices bottom out, is one of those factors wherein you see that the inflation might not come down going forward. It definitely hits to a great amount that it's raw material for the companies, and some amount of margins might be under pressure. But it also gives you an opportunity to increase your prices on an overall basis. So if you see in an inflationary environment, the staples will generally do far more better than the discretionary, because there is a natural pass-through of prices which generally happen, and subsequently higher profits on those companies. But yes, different industry would be affected in a different ways. But we have to live with it. I mean, we have to accept the reality that the commodity prices have bottomed out.
Right. A lot of consumer companies also do get impacted by the changes in the oil prices, a lot of other commodities. We spoke to Titan yesterday, post their results, and they were of the view that gains coming in from unorganized markets are very, very high. Do you think that could be one of the key triggers why some of the names like Havells, Blue Star, any of these names have seen the valuations the way they have post demonetization?
Of course, demonetization has helped the shift from unorganized to organized. You'll also have to take into account that when GST comes also, this push is going to get a huge amount of momentum. So what you may see is, because of transfer of business from mid-size or lower-size corporates to higher or to an organized industry, where there is not much of tax arbitrage left, there is going to be some amount of momentum, and that's why Street is factoring in those and giving them a high multiple. To what extent does it happen is yet to be seen, but definitely there are estimates that there would be good amount of beneficiaries in this segment.
Right. As far as airline sector is concerned, so after Indigo, what happened is that airline sector itself got re-rated. We are having a very big IPO of DMart also expected in the next 45 days, which is of course one of the leaders as far as the retail sector is concerned. You think retail sector itself could see a valuation re-rating on the basis of that IPO?
No, we have already seen. I mean, if you see last performance of last month, all the retail names have been doing very well in anticipation of this IPO. But rather than focusing on a pretty shorter term measure, I think one needs to make a larger term call or longer term call in terms of what's the future of the retail business, whether it's likely to remain in those amount of shopping malls, or it's going to shift to online, or there has been a massive shift already to online. So I would not be swayed by the shorter term events on this, but would probably wait for events to pan out or industry to shape up to take a bigger call at a later stage.
Can you talk about the retail pack? It's seen 7-8 years of continuous decline, high debt, very low same-store sales growth. Do you think things are picking up over there with less cash, more of digital usage? Can retail sector see a very strong bounce back?
Retail definitely is going to be robust, no doubt about it. But what we only have to see is whether is it going to happen on the stores or it is going to happen online. We are increasingly seeing the awareness of going online, making payments online, doing shopping online, right from groceries to your fashion. So there is a huge amount of change in the consumer behavior there. It's just that we'll have to wait, how actually the industry shapes up. See, the retail stores come with an inherent disadvantage of having to pay a huge amount of rentals, which is a sizable portion of their expenses. We are yet to see, how, as I said, I'm just waiting to actually see how the industry goes and moves forward, and then we'll probably take a call on that.
Right, but within organized retails, within branded plays, any correction would be a buying opportunity. These are names which have always surprised and come up with stronger business models after problem. No reason to believe that will change?
No reason to believe that it will change because the managements are pretty dynamic and they are keeping on learning new tricks of the trade. So I think a dynamic management in a particular line of business is always good, which will be beneficiary both for the company as well as the consumers. They have evolved over the last many years, and there is no reason for me to believe that they will not evolve going forward also. So that's why I'm saying that it's too difficult for me to probably forecast it, saying that in 2 to 3 years, this is the way of shopping which is likely to be. Because if you go and see something like an Amazon, right, the amount of innovation which they are doing, both in the stores as well as on the side, it's phenomenal. And that actually scares me, that how much would the retail guys be able to cope those kind of or those level of innovation. So that is where I'm coming from, to be very honest.
Right. Just a last word on the Telecom pack with the merger and acquisition or talks of 2 and 3 player coming together. Does that change the dynamics of the industry?
Consolidation is always good for the industry, no doubt about it, and especially when it is extremely competitive. So that's surely a big positive. However, we are not big fans of the whole business model wherein you continuously keep on doing capex and without any commensurate cash flows coming onto your balance sheet. So we will wait to see, these are the names. We'll probably rent it rather than own it, and would be more of a trading place for us rather than a long-term investment calls. But yes, you are right. In terms of the industry, in terms of business, consolidation is a good step forward. For getting the profitability back into the place.
Vaibhav, thank you so much for taking out time for us. Always good to get a perspective from you. That was a view coming in from Vaibhav Sanghavi.